Times are tough for investors trying to offload units and apartments here in Melbourne. As Chris Kohler discovered, 1 in 5 is now selling at a loss.
Bit of a glut in supply, particularly in the mid to late 2010s. On the demand side, there used to be a lot of investor demand, but that was punctured by changes to lending conditions in 2017, and even more recently with increases to investment property levies.
You kind of have to laugh, or you just spend the whole day crying, because this is killing us.
Continue to grow and it's become an insurmountable task.
I think for our share it's over 800,000 and our mortgage is 900,000.
Here's what nobody in Australia's apartment market wants to talk about. More than a third of all apartment resales across the country are now selling at a loss. Not 10%, not 20%, 36%. And the median loss, $60,000. That's someone's entire deposit gone. From Sydney to Melbourne to Brisbane to Perth, apartment owners are trapped in a position where they can't sell without taking a catastrophic hit, and they can't hold because the costs are eating them alive. In this video, I'm going to show you exactly how Australia's apartment market broke, which cities and suburbs are being hit the hardest, and what the RBA, Moody's and CoreLogic data says is coming next. Let's get into it. Right? Let's start with what apartment owners across Australia are actually facing. Catality's Pain and Gain report, the gold standard tracker of resale performance, shows that over 36% of all apartment resales in the latest quarter resulted in a gross capital loss. The national median loss for investors sits at $60,000. And here's the detail that should terrify anyone who bought in the last 5 years. The median hold period for those loss-making sales was just 3.7 years. People are buying apartments, discovering the real costs, and dumping the asset within 4 years, just to stop the bleeding. And it's concentrated, but not contained. In the city of Melbourne, the loss rate hits 45.5%, 9 times the national average. South Yarra sits at 41.9%. But Sydney's off-the-plan investor apartments from the 2015 to 2018 boom are bleeding losses too. Brisbane's inner-city unit stock is softening. Perth's apartment market never fully recovered from the mining downturn. Nationally, the apartment segment has structurally diverged from the house market, and not in the direction owners wanted. One apartment owner posted on Reddit laying out their exact position. Bought for $480,000. Current value, $450 at best. $365,000 left on the mortgage. First home buyer, stamp duty exempt. Their exact words, if I were to sell it would be at a loss, around $450,000 max. It is my first home and was exempt from stamp duty. That's someone who did everything right on paper and is still trapped. And the cash flow squeeze is just as brutal for those trying to hold. Another poster bought for $570,000. Mortgage repayments, $3,500 a month. Body corporate, $6,000 a year on top. They're renting out the spare bedroom for $350 a week just to cope. Their exact words, my mortgage payments are significantly higher than I expected, around $3,500 each month, plus an annual body corporate fee of $6,000. That's not a lifestyle choice, that's survival.
The capital cities, it's only the mid-sized capitals where home values are at their highest level on record. Sydney values remain 1.1% below the September 2024 high. Melbourne values are down 5.4% from the peak in 2022.
The most devastating single case came from the Barefoot Investors' own column. An apartment at 883 Collins Street, Docklands, was bought off the plan for $860,000 in 2015, listed for urgent sale in 2024, under offer at around $650,000. That's a $210,000 loss, not including 9 years of body corporate, council rates and maintenance. The Reddit thread discussing it was full of similar stories. One commenter, the individual who owned my apartment at 70 South Bank Boulevard purchased it for $800,000, but ended up selling it for $650,000. Now, to be fair, the broader national picture isn't entirely underwater. Catality's own data shows 94.8% of all property resales nationally made a profit, but that number is overwhelmingly driven by houses. The apartment segment, especially investor-grade high-rise, is a completely different asset class at this point, and if you own one, the headline number is cold comfort. But here's what nobody is telling you. The apartment crisis isn't just about falling prices. It's about what happens when the entire system that built these apartments starts collapsing at the same time. ASIC data confirms the construction sector leads the entire nation in corporate insolvencies, 27% of all company failures. In the 12 months to March 2025, 2,636 construction companies went under. When those builders liquidate, their statutory warranties evaporate. The apartment owner is left with a defective building and no one to sue. And the RBA's own Financial Stability Review singled out Victoria, the state with the largest apartment stock, as the only jurisdiction where mortgage arrears remain above pre-pandemic levels. But this isn't contained to one state. S&P Global identified 56 regions across Australia where mortgage arrears are worse than the national average. The fracture is national, and what's inside the data is worse than you think. So how did this happen? Start with the construction pipeline. ABS data shows private sector apartment approvals fell 22.3% in a single month in July 2025. By April 2025, they'd crashed 19% to just 4,999 nationally. Developers are walking away from high-density projects because the maths has inverted. Charter Kramer confirmed that new apartments in 2025 need to be priced approximately 30% higher than those built in 2020 just to break even. But with 8,000 completed apartments still unsold in Melbourne alone, and similar gluts emerging in Sydney and Brisbane, developers can't launch at those prices. There's competing stock available at massive discounts from the off-the-plan peak. One couple posted on Reddit that they'd paid a 10% deposit on land 2.5 years ago. Construction costs exploded from $280,000 to over $400,000, a 33% blowout. They can no longer afford to build. Their exact words, "We can no longer afford to proceed with construction." $25,000 in deposit, about to be lost.
Australia's housing crisis is in the spotlight this morning, with our target of building 1.2 million homes in just 5 years seriously lagging. The latest figures show just 260,000 homes have been built, nearly 100,000 behind target.
The mortgage stress data confirms the national spread. Moody's data shows Melbourne's west running at 2.45% delinquency, nearly double the national average. But the pressure isn't Victorian only. S&P Global data identified above-average arrears in regions across New South Wales, Queensland, Western Australia and South Australia. And nationally, the PIPA Investor Sentiment Survey confirmed 16.7% of all Australian investors sold at least one property in 2025, up from 12.1% in 2023. In Melbourne, the sell-off was even more extreme, 22.1%, the highest figure ever recorded. A Victorian landlord with 10 properties called 3AU Radio and said it on air. His exact words, "New taxes and regulations are pounding him into the ground. He's liquidating everything and swears he'll never again invest in Victoria." And while Victoria is the sharpest example, the investor exit psychology is spreading nationally. Another buyer captured the off-the-plan trap. They discovered defects and undisclosed changes before settlement. Their plan? Settle, fix defects under warranty, then sell after 12 months. Their exact words. Worst case scenario, we have to settle. And they fix the issues under builder's warranty. Then we sell after a year. An owner planning their exit before they've moved in.
Melbourne recorded negative 3% annual price change in 2024. Every other capital city in Australia posted growth that year. Sydney grew, Brisbane grew, Perth grew significantly, Adelaide grew. Melbourne went backwards, making it the only capital with negative annual movement.
To be fair, not every apartment market is in trouble. Well-located, owner-occupier-focused buildings with low body corporate and no defect history are holding value. And Roy Morgan's latest data shows national mortgage stress has declined to its lowest since January 2023. But 830,000 mortgage holders remain classified as extremely at risk. And the apartment segment, the one most exposed to body corporate, defects and oversupply, is where the pain concentrates. And here's where it gets worse. This isn't just an Australian problem, it's a global apartment market fracture. Toronto has 24,000 unsold condo units sitting empty, 60 months of supply. Construction starts down 84% from 2 years ago. New Zealand's apartment market has corrected 31.3% in real terms from its 2021 peak, the deepest correction in modern Kiwi housing history. Let that sink in. Australia, Canada, and New Zealand are all running the same playbook: oversupply, investor exit, construction collapse at the same time. And Australia's regulatory response has been the weakest of the three. So what does the national affordability picture look like? The National Housing Supply and Affordability Council, the federal government's own advisory body, released its 2025 report. The average time to save a deposit in Australia is now 10.6 years. The ratio of dwelling prices to median household income has risen to 8 times. 50% of median household income is needed to service the average new mortgage, and only 14% of median income households can afford to buy, the lowest level on record. The Grattan Institute confirmed the trajectory. The typical Australian home has gone from roughly 4 times median incomes in the early 2000s to more than 8 times today. In Sydney, nearly 10 times. And one commenter on Aus Finance framed what that means in practice for leveraged apartment owners. Since properties are leveraged, it's probably close to 100% loss of deposit. If you put down 60 grand and sold at a 60 grand loss, your entire equity stake is wiped. You walk away with nothing. The rental supply side is collapsing too. Victoria lost over 24,000 rental properties in a single year, the fastest quarterly decline in rental bonds since record-keeping began in 1999. And nationally, Catality data shows Australian rents have risen 43.9% in 5 years, while wages grew just 17.5%. The gap between what tenants can pay and what landlords need to cover their costs is widening, and the supply pipeline supposed to fix this is in freefall. A BS building approval data from April 2025 shows private sector apartment approvals crashed 19% to under 5,000 nationally. The federal government's target of 1.2 million homes in 5 years has delivered just 260,000, nearly 100,000 behind schedule. The housing Australia needs isn't being built. The housing that exists is losing value, and the people who own it are stuck.
Richard Temlett, National Executive Director of Research at Charter Keck Kramer, has posted that new apartments in 2025 need to be priced approximately 30% higher than those built in 2020 just to break even.
To be fair, the UK comparison tells a more nuanced story. UK mortgage arrears are actually falling, down to 0.92% of all mortgages in queue for 2025. Australia's national rate is higher and Victoria's significantly higher, but the UK never experienced the same concentrated off-the-plan investor boom that inflated Australia's apartment stock. The structural conditions are different, which makes Australia's correction potentially sharper and longer. So, where does this go? The optimistic take, rate cuts are flowing through, and Cotality data shows mortgage stress declining nationally. Some apartment markets will stabilise, particularly smaller owner-occupier buildings outside the glut zones. The realistic take, Charter Keck Kramer says 8,000 unsold apartments need to be absorbed before new supply can launch in Melbourne alone. Construction insolvencies are running at 27% of all failures nationally, and the federal government's housing target is 100,000 homes behind schedule. The bearish take, the RBA's own research, says low or negative equity increases the likelihood of both falling into arrears and transitioning into default. And the Cotality data says the median hold period for loss-making sales is 3.7 years, meaning the wave of buyers from 2022 and 2023 is just now hitting the point where they discover the real costs. If you own an apartment in any of Australia's major CBDs, the Cotality data says more than a third of apartment resales are happening at a loss nationally, and in some inner-city postcodes, it's nearly half. If you're an investor trying to hold, the PIPA survey says a record number of investors sold in 2025, and the cost of holding, body corporate, insurance, land tax, maintenance, is outpacing rental yields in most capital cities. If you're a first home buyer looking at off the plan, one buyer on Reddit is already planning their exit before settlement, and 8,000 completed units remain unsold in Melbourne alone. And if you're a landlord absorbing costs, one mum featured in Domain said she couldn't raise rent for 3 years while inflation surged and ended up $30,000 out of pocket. Here's the truth. 36% of Australian apartment resales are selling at a loss. The median loss is $60,000. Construction insolvencies represent 27% of all company failures nationally, and the federal government's housing target is 100,000 homes behind schedule. I'll be covering the apartment correction, the construction crisis, and every data update as it drops. Subscribe to the Mosen Report so you don't miss the next video. Thanks for watching. See you in the next one.